Welcome to today's webinar titled How to Build a Resilient Supply Chain When Facing a Global Recession, jointly presented by RapidRatings and our partner Resilinc. I'm Eric Evans, Managing Director of Partnerships and Alliances at RapidRatings, and we'll introduce our two co-hosts and will help facilitate questions from our attendees. Today's format will be a fireside conversation versus a slide presentation or lecture, as we want this to be as interactive as possible, so please put any of your questions in the chat. Our conversation includes two professionals in the supply chain risk space who are in touch with many companies given the client bases we both serve. Our first co-host is Bindya Vakil, CEO of Resilinc. She is credited with bringing supply chain risk management into the mainstream and has helped transform the way global organizations approach supply chain visibility and risk, driving them to shift from reactively addressing catastrophic supply chain events to putting preventive solutions in place through monitoring, mapping, and planning. Bindya is a founding member of the Global Supply Chain Resiliency Council and a member of the advisory board of MIT Center for Transportation and Logistics, holds a master's degree in supply chain management from MIT and an MBA in finance. She's been named Supply and Demand Chain Executive's Inaugural Woman of the Year, as well as appearing on nationally syndicated TV, radio, and print, speaking on the topic of supply chain resiliency. James Gellert is our second co-host and is the CEO and chairman of RapidRatings and has vast experience in credit, global banking, risk management, as well as supply chain. James has been awarded the Pros to Know title in the supply chain industry, and often a regular guest on broadcast news like CNBC, and quoted in publications like the Wall Street Journal and Financial Times. James also has testified to Congress and the SEC 7 times about the financial crisis and financial reforms. I will kick it over to James to start us off.
Eric, thank you very much. And I'd like to thank everybody for joining. We still have attendees who are coming on. Let me reiterate something that Eric just said. We'd like to encourage everyone to feel free to ask questions along the way as we go. Eric will be fielding them and shooting them in to Bindya and me. The more this is a true fireside type chat, despite being virtual, I think that the more interesting it'll be, and Bindya and I welcome any comments or questions that come along. Let me thank Bindya to start out. I'd also like to ask everyone for group support, as Bindya has just told me that her daughter is driving herself to school for the first time today at 16. So we all need to be as supportive of Bindya as possible on this stressful day. But congratulations. And today, as the title of our presentation has stated, is an extremely ambitious topic. There's an awful lot to try to unpack. There's no question we will fail in unpacking everything, but we do want to try to touch on a number of topics that both Resilinc and RapidRatings are hearing from our clients, are seeing in our data, and are understanding from the machinations in the market today. Bindya and I have had the opportunity to speak together many times. Resilinc is a great partner of ours. We have many common clients, and we certainly have collaborated in thinking through how we can together be real critical components for clients in developing the most resilient supply chains possible. For context from the RapidRatings side, for those of you who may not be as aware of the breadth of what we do, we provide insight into the risk of private and public company suppliers across industries around the globe through the mechanism of understanding financial health. Financial health we'll talk about more during the course of our session, but what we're doing is helping companies to understand the risks and the opportunities that lie with supply chain partners. Our business spans working with companies across over 25 different industries. So we have a pretty broad perspective on what the challenges are across different industries and upstream in their supply chains and the sub-industries that support them, as well as downstream in the customer bases that they're selling to. A number of our clients also use us for credit and understanding the commercial risk that they take in selling, as well as helping financial institutions to evaluate underwriting and credit products that they have. So as we're talking about the public and private company risks that we see and how they're affecting supply chain, hopefully we can imbue all of those thoughts with the information and the knowledge that we've gained across our client base and the industries that they represent. The things that our clients are telling us broadly right now, for background and tee up for this conversation. We're certainly hearing from clients that have been better positioned or have or multiple years into the establishment of risk management programs, that they have weathered the storm thus far, and we can define exactly what the storm is, but that they weathered the storm much better than those who have been later to embrace or still have not fully embraced risk management and predictive analytics in supply chains. Gartner had an interesting statistic recently saying that 22% of supply chains have embraced predictive analytics to date, but that this will increase by 2026 to 82%. That jump is enormous by any standards, but it represents, I think, a common knowledge across companies, industries, and professionals within them that the challenges that everyone has faced in supply chain risk management or supply chain over the last 3 years have to be managed better, more proactively in order to be able to go for the next 3 years. And there are a lot of impacts and a lot of influences on that. Many of those who have lagged in risk management to date have done so because they haven't had internal mandates from senior management or funding from senior management to be able to implement programs. So there has been perhaps the desire and the will to embrace predictive analytics, but not necessarily the funding or the support to do so. So they're playing a lot of triage and catch up when problems arise, as opposed to being able to be ahead of them. There's also a common concern about how to get data from particularly private companies, but even from public companies that people are doing business with, and a concern that disclosure will cause relationship problems and pressure on suppliers to produce information causes problems as opposed to causes or creates opportunities. So the big issues that we see right now are that private companies continue to be immensely critical in supply chains. Roughly 75% across industries, 75% of supply chains are made up of private companies. And we see really two kinds of professionals out there. Those who know they need to be proactive in managing risk, and those who are going to be in a lot of trouble because they haven't realized that yet. So it's a pretty common issue. Those who are prepared are going to be better positioned, whether it's institutionally or professionally for each person. We see that supply chains are filled with companies that fall into really three categories coming through the last few years. One are suppliers that are really genuinely doing quite well and have weathered the storm very nicely. Second category of companies who will fail, whether they go out of business or just file for bankruptcy and have to be reorganized in some fashion. There are many of those. And then the third category, which in many ways is even more tricky, and that's the companies that have been degraded operationally because of the last 3 years' conditions, but are still existing and can mask a lot of their problems through liquidity. Problem is that liquidity burns off, and if it can't be replaced, the operations can't be improved in time to keep them out of being either part of category 2 or demonstrating problems in some other way without failing. And that could be delivery problems, quality problems, health and safety issues, and so on and so forth. Finally, the last 2 points are that sub-tier visibility continues to be one of the hottest topics and the needs through the industry. And fortunately, Resilinc is a leader in that area, and NVIDIA has a lot of very valuable comments to make on how people can get more sub-tier visibility. And then finally, market volatility. We'll talk about that today, straight across the board, whether we're talking about interest rates or capital markets or consumer buying habits at the moment. There is a ton to unpack, and I look forward to being able to talk with Bindia and all of you about it. So Bindia, let me, with all of that, pass it over to you.
Yeah, no, thank you, James and the Rapid Ratings team. This is an exciting time to have this discussion. We are on the cusp of or may have already entered a recession. In fact, I would love to hear, James, your perspective on exactly what to expect, you know, in the next 3 to 6 months. But you know, just a little bit of background on Resilinc and myself. You know, I come from the world of direct materials procurement. I always laugh that I cut my teeth in supply chain risk management in 2000 with the tantalum capacitor shortage. So if any of you are either rolling your eyes on the call, smiling, or shaking your head in a resigned way, because the world learned nothing from that disaster, which happened in 2000, and that was a 0.02 cent part that was used in a lot of electronics manufacturing, electronics products, and it had a 12-month lead time, and it was one of the big contributing factors to the financial crisis, the dot-com crash, the one from 2001. And I was at ground zero, and really because I come from the financial world and was in portfolio management background, learned about value at risk, you know, and I was like, wait, why doesn't supply chain do value at risk? You know, why do we manage everything based on our top spend? We manage 20% of our highest spend suppliers that are 80% of the spend. But value at risk teaches us that we have to look at what happens if a supplier fails. And when you put that lens on your supply chain, every part is needed in order to build and ship a product. And so every supplier should be assessed based on their value in case they were not available, which means revenue at risk and not spend is the #1 metric for our business continuity. And so that's my background, you know, and Resilinc was a company that I started in 2010 after working at Cisco. I had this wonderful opportunity to actually work in proactively managing the supply chain, do the value at risk, we call it revenue at risk, build capabilities at Cisco around really mapping the supply chain, monitoring suppliers 24/7, and seeing that risk is a data problem. And if you can map your supply chain, really understand your geographic dependencies, and monitor them in real time, as well as know who are the suppliers that are involved. Our supply chain is hidden, right? So we don't know what subcontractors our suppliers use in different countries, their contract manufacturers, and then put them through a rapid ratings financial health management process, a robust supply chain risk evaluation process to really identify proactively where those biggest vulnerabilities are, where do we have those sub-tier failure points where, you know, 10 or 15 of my direct tier ones are all buying something from a sub-tier source. You know, knowing that ahead of time can be the difference between a really good quarter versus a bad quarter, which is what we're seeing right now. If you're on earnings calls, which I'm sure many of you are, then you're hearing the word supply chain disruption be the #1 reason for missed revenue targets, profit leakages, cost overruns, hundreds of millions in freight expedites, loss of jobs, and potentially now looking at a recession. So I think this is where the world is. I think this is also, you know, risk is an opportunity. So this is a wonderful time to say, how are we going to fix this? So just like Gartner, what James shared about Gartner's numbers on predictive analytics, we also see that a lot of companies are learning from what we could have done better that we didn't have in place over the last 2 years and 2.5 years of multiple disruptions. The #1 issue identified was that companies had not really looked at mapping their supply chain. We kept getting caught off guard, whether it was the pandemic and all the lockdowns that moved worldwide, whether it was Russia, Ukraine, whether it was Shanghai lockdowns, event after event over the last 2.5 years, we learned that we don't know where our parts come from. And so who are the companies involved in the supply chain? Now, as the world looks at a changing geopolitical landscape, with China being our kind of manufacturing basket of the world that is shifting, it's really important to really understand where is the supply chain heading, because these decisions about where the supply chain is going, who are the new suppliers that are coming into your supply chain, the subcontractors that companies choose in different regions of the world, these are the headaches of the future. So looking forward to this. And I want to maybe, James, turn it over to you, just kind of have you talk about just the broader market, macroeconomically speaking, what you are seeing across, you know, the financial metrics. Obviously, I talked about earnings season. You have a lot of insight into that. So can you give us what your assessment is of the next maybe quarter or two out?
Sure. You know, there's a lot of talk about whether we're in a recession or not, and I'm just going to lay it out there that it doesn't matter. The problems exist whether we're technically in a recession or not. We've got interrelated problems. Those interrelated problems, whether the chicken came before the egg or not, is no longer relevant. But inflation is a giant challenge in supply chains. We can come back and talk about that more in detail, but inflation is one of the big issues. The pandemic, which we are not out of, but I think we are through from the most immediate impacts. The most immediate impacts created a period of time that created so much liquidity in the financial markets, and really was a boon for many companies, particularly smaller companies and particularly private companies, to get through 2020 and 21 and into 22. But that liquidity has been pulled back out of the market. And with interest rates rising to combat inflation, we have two forces that are acting in a similar fashion. The withdrawal of stimulus capital and the end of a credit cycle of interest rates that has gone on since the financial crisis has created a liquidity withdrawal. And that liquidity withdrawal has happened systemically, and it's happened idiosyncratically at individual company levels. But the system-wide withdrawal of capital is a withdrawal of dollars that was being invested for years in the weakest companies, in smaller companies, and an entirely new market as well as an old market supporting private companies. So with interest rates as low as they were coming out of the financial crisis and all of the quantitative easing that resulted, institutional investors that were looking for yield and trying to match historical yield targets had to go down the credit spectrum and invest in weaker and weaker companies in order to get the yields that they previously got from less risky businesses. And as they went down the credit spectrum, they supported the lower end of the credit market. That was a tremendous amount of, tremendous influx of capital that was supporting companies that would be rated very low by us or any other ratings firm. But you add to that stimulus funding for getting through the crisis allowed more companies to paper over the weaknesses that came operationally from that period of time. Then you have companies that have high enough liquidity to look okay or to survive, but not strong enough performance to continue for the long term. Now you add inflation to that, and you add the geopolitical unrest, you add an energy crisis, particularly in Europe, but globally. You add commodity prices increase, which of course is part of inflation. That is a compounding effect, which creates something of a perfect storm. And that perfect storm is one where, whether we are technically in a recession or not, we are seeing changing buying habits from consumers. We are going to see less buying in certain marketplaces, particularly because prices are so high. And we're going to see that larger companies have the ability to withstand this shock and this storm for a longer period of time than smaller businesses. And public companies will have a greater ability to do it than private companies because they have greater and diverse sources of capital. Whereas private companies have oftentimes one bank that they may borrow from, and they don't have the ability to just add banks or to double their lines and things like that. So you take all of that, and it means that going forward over the next few years, we are going to see much more strain on private companies, much more strain on smaller companies. And as you go further up stream in supply chains, those that don't have the ability to pass through price increases are going to have significant margin pressure. And all of these are things that need to be understood. Bindia, you and I have talked a number of times about how sometimes we will hear a supply chain risk professional say, well, I haven't had a financial failure in my supply chain for the last 5 years, so obviously I've got a great risk program. And that is, unfortunately, it's a laughable statement, because the number of companies that have failed over the last 5 years because of bankruptcy are de minimis compared to the avalanche that we are about to see over the next few years, particularly in Europe, particularly with private companies, but globally. So all of this says more risk management is needed.
Yeah, just to give you a little bit of that connection, I know that a lot of you on the call are managing suppliers. So when you start to see things like what James just talked about, inflation, what we mean by how that impacts the bottom line of your suppliers is they're paying more for the raw materials that they're buying. The second concerning trend is the reliance on inventory. So a lot of companies during the pandemic ditched their lean and GIT strategies and began to panic buy. And so the 2 times demand went 4 times. So there was a lot of demand, fake demand flying around. Now, fake demand is a very dangerous thing from a financial health of a company standpoint, because that demand signal goes out to the suppliers. The suppliers saying, it's boom time, I'm going to build up inventory. So they're building up that inventory to a fake demand signal. Now, this is where this all falls apart, is those orders go out to the suppliers. The suppliers are not in good shape to support a 2x, 3x increase all of a sudden. So out of your 500 suppliers that go into a product like, a high-tech device or consumer electronics or other equipment, 400 of them might be able to support a portion of it, but we're now looking at allocations, which means a portion of your suppliers are actually delivering you these parts and inventories that you don't need. So now you're investing hundreds of millions in storing all that inventory that you received in. It's sitting on as unusable, illiquid, current asset cash on your balance sheet, tying up your cash into this additional working capital need. The hope, as James said, is you will go fundraise against that. But now think about the world that has changed with interest rates going up, liquidity is going down, and valuations are tanking. And so those companies that had all this inventory tied up in their balance sheet that go out to fundraise to support this, they can't go raise that money. And now they're in financial distress. Now, what we are seeing as a result in the Resilinc data, as we monitor these supply chains constantly, we're seeing increased activity of business sale, spin-off, mergers and acquisitions, leadership changes, because yes, CEOs and CFOs do change when the company the board sees that the company is not meeting the revenue targets, they're not meeting their profitability targets. Those are the leadership changes that signal massive strategic overhaul of that company. It's also, and like I said, risk is an opportunity. This is also an excellent time to look at some of your critical suppliers, and particularly if you're one of the companies that has invested in supply chain mapping and really understanding where you have multiple tier ones who are buying from the same sub-tier source and it's constrained. Now's a great time to learn about the financial health of that company, meet with the company proactively, see if they're experiencing any challenges, and prop them up. Now, M&A is a great strategy to control some of your, supply chain M&As are actually thriving in this environment. But also, I wrote about this last year with Tom Linton. It's an article we wrote in Harvard Business Review called "It's Up to Manufacturers to Keep Their Suppliers Afloat." Now's a great time to talk about financial health or problems and challenges but not to exit out the door if the supplier is transparent, but to double down, particularly with those suppliers who are your high revenue impacting suppliers, who are your strategic partners where you have joint IP, your fates are intertwined because they're single source on some of your highest value product lines. Now's the time to help them. Now, here are a few ways you can help your suppliers when they come to you discussing some of the financial challenges they're struggling with. One is you can pay them early instead of making them wait 120 days, because let's face it, we in procurement do that to our suppliers. This is not the time to push for those payment terms. Now's the time to be good partners. Another one that I've seen work really effectively is when companies actually buy ahead, because the supplier can take your order POs that you place and go raise capital against that. That's a really good way for your suppliers to build that trust, that relationship, that, hey, when I had a bad day, this was the customer that stood by me. Guess what? In future, when you're struggling with allocations and begging for inventory and parts and capacity, they will remember that. So this is an awesome time to really partner in full transparency, but with good behavior. So not to run out the door, discontinue working with that supplier and make their bad situation even worse, but to really, again, going back to revenue impact based, right? So really understanding who are the suppliers that your revenues are relying on. Are they single sourced in your supply chain? And those are your partners that you double down with. Obviously, not every company has unlimited cash as well. I'm sure many of the listeners are like, well, I may not be one of those companies, but see, within the purview of what you can do, some companies also reduce some of the requirements. SLAs can be relaxed to give the supplier some additional runway on resource usage, etc. So there are lots of things that when you put your heads together in a spirit of partnership that you can collaborate on during these difficult times. James, any thoughts on that?
Yeah, Bindi, I think you've touched on an incredibly important and opportunistic topic with supplier collaboration. And as I get to that, I just wanted to add to one of the prior points you made with some statistics. We looked at companies, just about 16,000 public companies and a little over 60,000 private companies across the 2020 and 2021 period. And these numbers are reasonably staggering, but when you look at the percentage increase in cost of goods sold in public companies versus private companies, during that time, 20 to 21, public companies had an 18% increase in cost of goods sold, and those 60,000 private companies had a 102% increase. So an exclamation point on your comments about the additional costs. And when you then look at staffing and labor costs, and everyone knows we've been in a really fascinating labor market, public companies during that time had a 10% increase in labor costs, and private companies had 168%. So when you're talking about a group of businesses that have a very challenging time passing cost increases through, the only place that goes is to increasing losses or eating away at margins. And that's just not sustainable for many private companies for an extended period of time. So tying that back to the question of collaboration, we absolutely see the same trend, which is companies trying to understand whether they can collaborate more with their suppliers, should collaborate more with their suppliers, and what it means if they do one or the other. In our domain with financial disclosure, historically, a lot of companies have felt that their suppliers won't disclose financial information. The success rate that we have in getting companies to comply and to disclose is extremely much higher than any company we've ever faced or ever worked with in their own ability to get suppliers to disclose. But this period of time is one of the best ever to be able to do this, because private companies recognize that there is a commercial opportunity to that disclosure. And transparency is part of relationship building It shouldn't be considered part of a process to be managed out. And in general, certainly our clients are not looking to replace or remove their suppliers because there are costs associated with that, and those are costs that are precious and dollars that are precious and can't be misspent. So the ability to continue to work with a supplier, even if it means some accommodation or helping them, is almost always cheaper than switching. And in a period of intense, I won't say that we are moving away from globalization. I definitely think globalization is being challenged, and there's a re-globalization as companies shift their supply chain from one place to another. But I would strongly encourage people to continue to embrace the idea that by collaborating with suppliers and by having the disclosure of something like financial statements to be evaluated by us is a roadmap and a bridge to doing more together, as opposed to having to be something that is threatening and going to cease or hurt a relationship. Now, where we have seen some really interesting things just over the last 6 months are more smaller companies, and I would say smaller in this case, 500 million in revenue type, so sort of a tier up or 2 tiers up in many people's supply chains, feeling like they can't put the pressure on their suppliers because their suppliers have alternative customers to sell to, and that working more closely with a supplier may actually be would be a competitive disadvantage in terms of a continuous supply. I think that is very short-sighted, but it is an interesting comment we've heard from a handful of clients. So I want to tie that back to the mapping needs for companies, because the more one understands their supply chain through multiple tiers, the better off their resiliency is. And one of the challenges that I would suggest companies are facing is that their suppliers and suppliers may themselves not be doing a good enough risk management job. And there are ways of helping your suppliers to do better risk management. But if you're not, in addition to everything else, trying to understand just how good a job of risk management or commitment to risk management exists in certainly your tier ones, but to the extent you can in tier twos, you're just allowing a perpetuation of more time bombs ticking away in various parts of the supply chain.
Yeah, I think this is so powerful. There are several things you said, James, that I want to just maybe take a little bit further, right? One is this idea of transparency should never be punitive, right? If a supplier is transparent and then you basically use their openness and the visibility, whether it's a financial health thing or whether it's when we do mapping, suppliers are sharing data about who their sub tiers are and where parts are actually manufactured, who are the subcontractors in their supply chain. One of the fundamental principle and philosophical agreement we have with our customers is you cannot use this data to punish the supplier and yank business away from them, because that jeopardizes the entire transparency and mapping program, as well as something like rapid ratings, where you're trying to get the supplier to provide you with their financial metrics and health related information. So the only real use of this data should be to have a collaborative problem solving and constructive conversation, right? And the constructive conversations we see are things like, I noticed you manufacture this for me here. Do you have a backup site where you can build this for me? When it comes to the Resilinc use case, right? When it comes to the financial use case, I already talked about the things you can discuss to solve financial health related challenges. But when it comes to mapping, it's like sometimes, and I come from a world of high tech. So we were 70% single source, sole source in many cases. Supplier had all the IP for us, a lot of the semiconductor, the ICs and things like that across a battery, and lots of different parts were custom built that went into our products. And so second sourcing was not even an option. So you had to work with the supplier. Now, the powerful thing about a sole or single source relationship is if you put them through a rapid ratings process, and you discuss and have good relationship at the CXO level, that this transparency and trust and collaboration, you actually are freed up to do more problem solving on the supply chain resiliency side by having backup side. Sometimes we used to actually fund mask sets for semiconductor suppliers. So a backup side could be, we could do a test run, manufacture a set of sample products, you use that to do a qualification and make sure that the backup side could support our needs with the right quality levels, and then put that aside as an investment in resiliency. Now, the ROI comes in, right? Which is, how do you justify this extra work? A crisis has not happened. You're doing this to protect the supply chain. So the way we did it was, again, I'll come back to frame it up as a revenue impact issue, right? So I will give you my best, most illuminating example of my life, which is we had a connector supplier, $250,000 a year in spend, and it was sole source. It was a custom built connector for us, and one site made it. It was we were very concerned about it because if that connect now we went to our leadership and said, hey, we want to have another supplier for this, and it's going to cost us $400,000 to get this connector supplier up and running, give them the design, get them to build it. And we got rejected. They're like, no, we spent $250,000 a year. We're not spending $400,000 to go get another connector supplier. So I came back, I'm like, but why am I concerned about this connector? Okay, the reason I'm concerned about it is if I lose this $250,000 connector, it goes on my product line, which is $4 billion a year in revenue to us. So I went back to the leadership and rephrased this problem. Hey, if I lose this supplier, the impact to revenue would be $4 billion. By the way, it's not easy to get another supplier qualified and tested on all of our products for at least 18 months. So that 4 billion impact could easily be 6 billion. We have 8 weeks of inventory, give or take. That's all we have. So now we got approval. Now, interestingly enough, we wanted to go into another supplier with that issue, but instead what we did was we went to that same supplier, and here's what ended up going down. We told the supplier, we don't want to take this business from you. Give us your financial health. So we put that through the financial health process. We assessed that they were actually doing fine. We identified another site in a different geography that the supplier had, and we paid them. Instead of us spending $400,000, we funded $100,000. The supplier funded $100,000. Same supplier, a different site, and we got that qualified. So the cost of mitigation came down. The partnership got stronger, and because the supplier and us, we worked together on this, that supplier ended up winning more business with us. It was a win-win. And so this is the number one takeaway, is that when you work together for business continuity and supply continuity, you're not splitting the pie. Your continuity of supply is revenue growth and revenue assurance to the supplier. Your incentives are fully aligned. They will be at the table to solve this problem with you. And that's how cool this whole process is. I will tell you, squeezing the last ounce of blood from my suppliers was soul crushing for me when I was in procurement, but I thrived on these types of conversation. My job satisfaction level went up. I felt good about myself at the end of the day. So good things happen because you're working on something positive versus, hey, hit you up for cost savings every day. James,
That's great.
you must have so many examples of this.
This fits really nicely with the question we got. How have your clients best framed ROI when requesting funding for supply chain risk management? Bindi, you touched on the revenue impact. James, if you wanted to add something to that, but I think Bindi touched on some of the ROI.
I think Bindi's example right there is a fantastic one for the depth of relationship improvement. And just as that particular supplier in your example was able to expand out or invest in an additional site and had effectively co-investment or prepayment from you, but had liquidity from you to be able to do that, it's important to recognize that that every decision that a supplier is making in some way ties back to whether they have the financial ability to support the decision. So financial health of a company is absolutely critical and foundational to everything that they're doing. It's not just another domain to have a box checked and then move on to whether they've got cybersecurity readiness or something else. A company's ability to invest in cybersecurity readiness or to maintain the levels that you brought them in with is all based on whether they are financially sound enough to be able to continue to do that. And so this is an area where, ROI, Eric, is an interesting one, because the value that a supply chain risk program gets from understanding the financial health of suppliers in many cases appears in another risk domain. And that risk domain may be in quality and delivery. So things that traditionally weren't considered risk in the way risk is now defined, but we have found from clients in looking and analyzing their data with them, that there is a very high correlation between the riskier financial health companies and instances of quality problems. So fault rates are 2 times higher. Delivery is 2.6 times, delivery problems are 2.6 times higher with companies that we have rated as high risk. But when you think about now some of the newer influences and impacts on suppliers that are coming from their clients, in particular cybersecurity readiness, ESG investment as two of the two big newer ones over the last, call it 5-7 years, the amount of money that suppliers are being pushed, in some cases audited against, for investment in those two areas in times of distress, in times of financial weakness for them, are going to mean that they're pulling dollars away from research and development and quality and safety and other areas, because they have to comply with your audit standards for cybersecurity and your audit standards for ESG. So do they become a lesser partner from an innovation standpoint because they're unable to invest in R&D and in product development? Yes. And you only know that if you're able to look at their financial health and have the financial health be a part of a more holistic view of their risk, as opposed to just being a separate item that's being evaluated. So the ROI, or the value of looking at suppliers through this lens, as well as the others we're talking about, is incredibly important, but it is much broader than what historically people have done, which is to say, if I have a supplier that goes bankrupt, obviously I didn't evaluate their financial strength well enough. And if they go bankrupt, that causes me X problem. That's how I identify my ROI. ROI is much, much more complex today. Looked at another way, for those who are looking to find funding for their programs, there are many additional pockets inside of a company, and there should be many additional ways of being able to talk with management to get funding for financial health programs. And then as you map into the deeper tiers of your supply chain, being able to apply that more broadly.
Yeah, I have a couple of pointers as well on the ROI question. So a couple of things to think about is that when you don't have a supply chain risk program, there is a cost of operating with that level of risk. That cost manifests in financials in the following ways. Number one, how much did you pay in PPV, what we call purchase price variance? When you were trying to buy a part that was a $2 part, you had contracted with the supplier for $2, but you ended up having to pay $4. That's your purchase price variance. Calculate your ongoing PPV dollars. Calculate freight expedites. The reason we have to do air freight on parts and products that could easily be ground transported is because we're in a supply chain disruption. So over the course of multiple quarters, calculate what you have been paying in freight expedite. I will tell you, a company I talked to recently said they paid $700 million in freight expedites alone in the last year, 2021. So this is the type of stuff that gives you the numbers. Now, if you are looking at redesigning your supply chain and moving factories into a different region and regionalizing, if you're ditching GIT and inventory, you're basically adding hundreds of millions of dollars in cash and working capital needed in order to run your business, if not billions. I mean, a new factory can run in billions of dollars. So when you start to look at how are companies justifying this, right, versus the cost of managing your current and existing supply chain footprint with greater financial transparency and more mapping, that cost is less than $1 million a year. And it gives you resilience across climate issues, bankruptcies, supplier quality problems, supplier factory fires, regulatory changes or what have you. So having mapping, monitoring, financial health programs, the cost of that can scale far better across multiple years than the type of big ticket changes like ditching JIT. What if you could be lean and resilient at the same time? How much would you be willing to pay for that? Because ditching lean is going to cost you $200 to $300 million a quarter if you're a large company. I mean, that's a ton of extra cash and money that you're going to now raise, get diluted, go to the markets, pay in legal fees. I mean, there's so much cost of risk that we take on. And so really thinking about these and talking to the leadership, by the way, I will say this, risk is a top-down initiative. This is the time when boards talk about supply chain risk in their boardroom conversations, when they have to report to street their results and they use the word supply chain disruption 30 times in their earnings announcement. This is the time when one of you guys can lead the charge at your company, be that change agent, and say, hey, I volunteer to fix this problem by starting a supply chain risk program with these elements: supply chain monitoring, mapping multi-tiers of the supply chain, putting a financial health system and monitoring capability in place, and here's the benefit.
Another question came in. Are there certain industries or segments of companies you see being more or less at risk for either one of you?
So I'm happy to start. So I'd address that in two ways. Across industries, we see risk in segments of those industries occurring more with smaller companies today than with larger companies. So that's pretty straightforward given everything we've talked about so far today. The smaller companies having a bit less agility, having fewer sources of capital, and having less ability to pass through cost increases, such as the ones that I mentioned earlier, definitely have put those businesses in a more difficult position. If you take industries like retail, for instance, you've got a big schism between large companies and small companies as measured by sort of the 50 million and smaller in revenue size. Bendia, you and I have talked many times about the semiconductor industry and the very similar effect there. You've seen larger companies with higher and increasing inventory levels, and the middle-sized to small companies having smaller because they aren't able to warehouse as much. They haven't had the dollars to be able to stockpile as much, but their financial health, which is a shorter term, the 1-year perspective on risk, and the core health, which is a 3-year view on the fundamental operating efficiencies of the business. In both cases, for smaller companies, those have weakened. So we're seeing that across the board, and then some industries a little bit more than others. When we look just broadly speaking at all sizes of companies, the industries that we see being affected, it's interesting, coming through the COVID portion of the crisis, we certainly saw improvements in some pretty, I guess, maybe obvious industries like leisure, which had taken just such a pounding in the early part of COVID. But today, as we look forward, we're seeing weakness in pockets, but we're in the process of running a whole variety of stress tests, which do things like increase cost of goods going forward, and increase labor costs, increase costs of capital through interest expense, reduce profitability, reduce revenue, and a variety of other connected simulations. And when we do that, we see a significant decrease across the board in industries, but we see the industries that are doing better through stress testing in the public sector or public markets, biotech, drugs and pharma, healthcare. All of those industries continue to do relatively well while stressed, whereas autos, energy, food and beverage have all gotten hit pretty hard. The private companies, we similarly see strengths in health services, drugs and pharma, and then aerospace and defense, whereas those that have been hurt the most are ones like building products, consumer products, forest products, transportation, and leisure. So, you know, all of these are industries that are going to be affected in different ways, given the combination of consumer spending, building and construction, housing starts, the housing market, all of which is so closely tied to both interest rates and inflation.
Yeah, and just to add from my perspective, you know, honestly, sometimes we have this notion too big to fail. It's not a thing when it comes to supply chain disruptions. You know what they say, for want of a nail, a kingdom was lost. And small parts can bring down big ships. And so we just definitely want to kind of put this message out that when you see a massive shortage, that companies are missing their revenue targets, they may not go bankrupt. They might get acquired. They might spin off critical businesses into smaller companies. You'll see a lot of that activity. These things happen, and companies do that when they're doing a strategic realignment to protect the core parts of the business and get rid of everything that is not profitable, that is a money pit, you know, profits are leaking, etc. And that might be one of a business unit that makes a sole source component that you rely on. And that's why, you know, just because a company is financially healthy from a public domain standpoint, or we can't use any of our usual, you know, metrics, I will say. We have to look at the revenue impact picture and really assess what is going on in the markets of those companies that we rely on that are sole source. Again, I will repeat the criteria. It's sole source, difficult to replace, used on our highest revenue products that that have very high revenue, that can be easily substituted, right? So these are some 3 or 4 criteria, irrespective of the company's public or private. I will tell you, private valuations are low, and so definitely private companies, to James's point, will have a harder time with fundraising in the current environment. But even public companies tend to do a lot of strategic reshuffling, and you could easily have a critical supplier that makes a decision that is not in your best interest. So it's really critical to have a very well-rounded program right now.
The remaining minutes, do you want to address, we got the question, what is the outlook? What do you predict for the rest of the year?
James, go ahead.
Look, we are, if everything we have said is not a point in time. All of these problems are going to continue through at least 2023, and I would say some of these will be factors out into 2025. When you look at trends in capital allocation, junk bond levels are seeing the greatest outflows that we've seen in years. Prices for junk bonds are at 2008 levels. We've seen loans at around 40% of last year's volume year to date. So significantly less capital going out, significantly higher standards for lending that are being put in place, higher interest rates. All of this on top of the operational challenges that companies are having are all leading to a greater strain. And with higher interest rates, of course, causing for all bank borrowers, which is going to be most private companies, that means their cost of capital is increasing at the same time as all of their other operational costs. These are things that are going to be going on for quite some time. And I would imagine we are looking forget just the end of this year. When we get into 23, 24, we're going to be looking at default rates that are going to be close to twice as what we've seen in this past year, and we could even see them higher than that. When we simulate through our stress testing probabilities of default for companies across all industries, just going out for 1 year probabilities of default, not even looking out 2 and 3 years, we're seeing doubling or tripling of default probabilities for companies across different industries. So these are all challenges that everyone has to navigate. The biggest change that any company that is early or nascent in their risk management programs is that can change. The market conditions are going to take time. The conditions for risk management inside of each individual company can change immediately, as long as there is funding and there is a will to make the change and operational alignment. If that all happens, risk can be managed. It can't be eliminated. You can never eliminate risk. You can manage risk. But if you don't know what it is and don't know where it is, it's going to hit you. So that's the biggest change that any individual company can make between now and the end of the year.
Yeah, and I agree with everything James said. And when you layer on top of all the financial concerns, all the climate issues, we're seeing record 1,000-year floods and droughts, and factories need uninterrupted water and power in many cases. Labor, just issues across the board are not going anywhere. I will say the good news, because I always want to end on a good note, right? So yes, it's doom and gloom. We are facing unprecedented challenges in supply chain, but this is, I will always come back to, risk is a time of opportunity. Now is the time to change your fortune. This is the time where companies that really say, okay, let's look back at the last 2.5 years. What did we do well? What did we not do well? Where do we see the opportunities for improvement? How can we build resilience? What technologies, what data is available to me to manage, not only manage and survive, but thrive in this uncertain and changing landscape of the future? This is a time where we have unbelievable access to technology, data, collaborative networks, the type of stuff that Resilinc has built, what RapidRatings has built over the last 10, 20 years. This is a time where the only thing holding us back is our adoption, right? So how do we figure out and now is the time to do something to take the organization to the next level and prepare, because again, if you're looking to build new factories or put up warehouses or throw bodies at the problem, you're going to spend millions of dollars more than what it would cost you to have data, technology, predictive analytics, and these types of capabilities. The ROI will be far, far greater. And the cost is going to be far, far lower than some of your alternative approaches. And so now is the time to step up for leadership, to be a change agent in your organization, whether you're a chief procurement officer, whether you're a CSEO, or whether you're an individual contributor program manager. Now's the time for those people who feel it's the time, I'm willing to be the person to lead this, to step up and make a change, and I think that's what I want to, and I will say those are my final thoughts. It's a time of opportunity to fix this for the future.
I think that's all very well said.
Absolutely. And we will address any remaining questions via email for any of those we didn't get to. And we thank James and Bindia for being on today, sharing their perspective. We thank all of you for joining. So to learn more about Resilinc or RapidRatings, please check out the websites, and have a great day.
Thank you, Eric. Thank you, Bindia. Thank you, everyone, for attending.
Thank you, team.